Happy New Year. This is our first Employment Friday of the year. And as you know, ever since the coronavirus crisis started, I have been giving weekly or monthly updates. Now, why have I done that? For a couple of reasons. During the coronavirus crisis, when it hit, it was clear to me that the headlines that people were reading, generally, both investors and the general public, were not capturing what was really going on in the economy. There were a lot of economists, famous economists and others, strategists as well, who were looking at the economy shutting down and were basically preparing people for a depression, if you'll remember. And you can go back to those videos. In the early days, they were called Stay at Home with Cathie, and then we switched to In the Know. And as you know, back then, I was very focused on the possibility that this was a shock from which we would recover very quickly. And that turned out to be a correct call. And every week in the beginning and then monthly, I was delving into the economic reports that were coming out and into the earnings reports and pulling out evidence that supported or refuted that point of view. And that worked. Well, today we have a very different point of view, once again, about what's going on out there. And so that's why we do these videos. And I will get into that in a moment. First, I'd like you to alert you to a blog that I wrote in mid-December. It's on our website. And it goes into why we believe that innovation is in deep value territory, and goes through and refutes a lot of what we believe are the myths out there about innovation. We believe that COVID-19, the coronavirus crisis, accelerated the shift towards the innovation platforms around which we have based all of our research. And I'm going to give you a few examples of that in a minute. I do want you to know that, of course, we've been through a very difficult time since the significant rotation from growth into value started nearly a year ago in mid-February. And I want you to know that we're in there with you between the company and Ark funds, which are more than half of my IRA, and the significant percentage of my total net worth. We're all in, and my conviction couldn't be higher. That the innovation that has been evolving and was accelerated coming out of the coronavirus crisis is unstoppable, and the convergence between and among the 14 different technologies that we are researching, that convergence is underway now and is causing and will continue to cause explosive growth, really the likes of which we haven't seen in our lifetimes. And when I say explosive growth, I mean when it comes to those innovation platforms, they're going to cause a lot of problems for the underlying economy, the traditional world order. And I'll explain a little bit more about that in a moment. So what has happened is in the early stages of the coronavirus, when I was doing those videos, we had algorithms and quantitative strategies focused on just a few variables. They were at that time cash burn and cash cushion. And a lot of our stocks did not have big cash cushions and were burning cash, especially in the genomic space. And they were taken down by 75%, many of them, in a month, just in a month, 3 weeks to a month. And of course, that was the wrong answer. The algorithms got it wrong, and that there was a massive head fake, caused a lot of consternation for the quantitative strategies out there. Because, of course, genomics was a big part of the solution to a problem we were facing in the coronavirus. And since February, as this rotation into value from growth really accelerated, these same algorithms have had good success with this strategy. They've been focused on inflation fears, interest rates, and valuations. And they have likened what we're going through right now to the tech and telecom bubble and the bust. And so the algorithms as well are basically looking at momentum and saying, once the bubble pops, that's what they're calling this, it doesn't stop. It's 80, 90%. We think that is a vestige of the tech and telecom bubble and bust. A lot of strategies started moving towards benchmark sensitivity because of the tech and telecom bubble and bust. And they really stopped focusing on true innovation, transformative innovation, disruptive innovation. So the gleam in the eye, the dream during the tech and telecom bubble, investors were falling all over themselves to get the next deal and to ride it, up hundreds of percent within a few days. And of course, that was not real. I'm going to read you some of the companies that went poof from that time. These were the largest .com busts: Pets.com, Webvan, eToys, GeoCities, TheGlobe.com, Go.com, Flues.com, DrCoop.com, and Cosman.com. Many of these were out of business within a few years because they were being priced on nothing but eyeballs, not just current eyeballs. Dr. Coop, for example, averaged 1.4 million monthly average users, or the equivalent thereof. And it went public in June of 99 and was out of business in December of 01 because the valuations that people chased were simply based on eyeballs that might materialize and never did materialize. We are nowhere near that situation now. The dreams back then, so the internet was quite transformative and led to the cloud and artificial intelligence. We are living in the reality that dream started. And this reality has companies like Teladoc and Zoom, just to give you a sense of the contrast here. Teladoc has about $2 billion in sales. Its revenues have gone up fourfold since the beginning of the coronavirus. And we don't think that its revenues are going to go down. What we're seeing in the market is a focus on year-over-year momentum. And the comparison that we're going to see, and this is the last of the really tough comparisons, Zoom's revenue 1 year ago, fourth quarter, was up 370%. And in this fourth quarter, the quarter they will report soon, we believe, and their guidance is that revenue will be up 19 to 20%. Think about that. On top of 370%, up 19 to 20%. And that's probably the low point of its growth rate. And we're going to accelerate, we believe, or Zoom's revenue growth is going to accelerate from there. I gave you Zoom. Its revenue, is up 6.5-fold since the beginning of the coronavirus. Teladoc, another stock, telehealth, its revenue is up fourfold. And the Teladoc's revenue is $2 billion on average per year, or this last year. Zoom's about $1 billion. So these are real companies. Their gross margins for Teladoc, they're in the 60s, high 60s. For Zoom, in the low 70s. I may be mixing some of these numbers up, but you've got the point. Very high gross margins, solid revenues, growth continuing from very tough comparisons. And we've got two companies here that are being dismissed as stay-at-home stocks that are going to fall back to earth. And we believe they are not stay-at-home stocks. They are stay-connected stocks, stay globally connected, stay competitive, stay globally competitive. Teladoc being the backbone of the healthcare system from an information point of view here in the United States. And Zoom becoming one of the most important companies, we believe, in the enterprise communication space. Communications is a $1.5 trillion market, enterprise communications globally. And we believe that Microsoft and Zoom together are going to benefit from the first, quote unquote, rip and replace cycle since the early days of the internet in the early 90s when Cisco came of age. We believe that the dismissal of these stocks is quite misplaced and suggests that analysts or investors are not doing their homework and sizing these markets appropriately.